I've chosen to start today with a little joke, actually, and it illustrates a point which I'll go on to explain. An elderly man went to a doctor complaining that his wife could barely hear. This was of great concern to him. And the doctor suggested an opportunity to try and rectify this problem. And the doctor said, stand behind her and ask a question and then slowly move forward and see how far away you are when she first responds. The elderly man was excited that he felt as though he now had a solution to this problem. So he runs home, sees his wife preparing supper and says, "Honey," the man asked, standing around 20 feet away, "what's for supper?" No answer. And after receiving no response, he tries again 15 feet away. No response, no answer. Then again 10 feet away, again no response, no answer. And finally 5 feet away he says, "Darling, what's for supper?" She requires, for the fourth time, "It's lasagna." What's the moral of this story and why do I share it with you today? This is because you're in this concentrated environment where you've come to learn about employee share schemes and employee share trusts. This is the opportunity to get 5 feet away from understanding everything you need to know about the subject. The opportunity to listen and to study and to go back to your practices well equipped for the task at hand. So, let's, without more ado, go on into the presentation. So, this is my practice, David Craddock Consultancy Services. We are specialists in employee share ownership and reward management, a practice that I established some 20 years ago. We've expanded our work into management buyout, share valuation, and also investment education. And here we are today at the St Pierre Park Hotel to present this case for using employee share schemes, employee share ownership techniques for management buyouts. We every year have this conference at the Institute of Directors in London. We had our conference last month, and that attracts many leaders and directors from the SME sector. And I always say on that occasion during my presentation that if you're contemplating a management buyout, employee share ownership is the way to proceed. This is the most tax effective way to proceed, the most tax efficient way to proceed, and indeed it will produce the most commercially effective outcome. So what I'm seeking to do during this presentation is to provide an explanation of the principles which we use that I've applied consistently and continue to apply consistently in case study type arrangements to establish management buyouts through the execution of employee share ownership techniques. So moving on to this slide, what I've identified here is the origin of these techniques. The origin of these techniques goes back to the work of Louis Kelso, an economist and a lawyer, working with the owner of Peninsula Newspapers, a company in 1956 in Palo Alto, California, who wanted to organize a management buyout. But there was a conundrum. The owner of Peninsula Newspapers wanted to sell the company to his employees, to whom he was committed and had been throughout the whole of his working life. The employees wanted to buy, so there was that willingness to buy. But one problem, they hadn't got the money. So what do? Well, Louis Kelso established the Employee Share Trust, working alongside employee share teams as a mechanism to make this possible. And indeed, moving further into the late 50s and 60s and 70s, the idea was taken up by Russell Long, the son of Huey Long, the Democratic governor, one-time Democratic governor of Louisiana. Russell Long, then a senator, took the idea to Senate, and so into statute came the whole concept of tax efficiency within employee share schemes. The US government recognizing the commercial effectiveness of these techniques and recognizing indeed that the employee share trust lubricates the operation of employee share schemes. So what I'm going to show to you today is how these techniques worked out in that Peninsula Newspapers case and how we replicate those techniques case after case after case through our practice in order to establish effective and efficient management buyout arrangements. So, how does the Employee Share Trust work for the MBO, and what is the basis for financing the MBO? I've developed a set of diagrams which I include in my books and my articles, and which I'm presenting here as part of the presentation today in order to illustrate these principles. And also, very importantly, to highlight the importance of getting absolutely correct the financing techniques. So, in the absence of a recognised stock exchange, how do we establish the quantum of finance which is appropriate for the management buyout arrangement? Well, We use surrogate share prices. Yes, for a private company, we use surrogate share prices, and we establish those surrogate share prices through the application of recognised share valuation methodologies. Yes, the share valuation principle is enshrined in section 272 of Taxation of Chargeable Gains Act 1992, where hypothetical seller comes together with hypothetical buyer. They have knowledge of the company, equivalent knowledge of the company, and they come to an arm's length agreement. How do we reflect that principle in practice? How do we apply that principle? Through the share valuation methodologies, typically earnings basis, assets basis, dividends basis, offer basis, various other methods for establishing a share price, and that share price provides the basis for our calculation to derive a finance position which is appropriate for the management buyout arrangement. So, let's move into these diagrams. There are 7 diagrams which illustrate the principles which Louis Kelso applied to Peninsula newspapers back in 1956 and which we consistently continue to apply today. Not just my practice, but other practices which are represented here in the form of my esteemed colleagues sitting at these respective tables. Hello, guys. So, diagram 1A, company funding through contributions. Okay, so here you see the basic diagram which I use, which is company on left-hand top, trust on right-hand top, existing shareholders left-hand bottom, employees right-hand bottom. And so here we have the classic vanilla version where company provides contribution to trust, so money flows from company to trust. Trust in receipt of funds is able to purchase shares from existing shareholders, yes? So cash travels from trust to shareholders. In return, shares travel from shareholders to trust. Shares then in turn travel from trust to employees, maybe immediately, maybe over a period of time through the exercise of options or some other employee share scheme technique, so that ultimately we have the shares in the hands of the employees. Yes? So if the company, rather than an external financial institution, is funding the management buyout, then the trust is funded and either through gift contribution or through loans. Okay? Where loans are advanced to the trust, which is what's depicted in this next slide, where loans are advanced to the trust by the company, it is of course possible at a later stage to make contributions from company to trust through a circular movement of cash through accounting entries in order to enable the trust to pay off the loans, to extinguish the loans so that the trust is then free of debt. Okay? Moving on to this next slide, which is diagram 2. This is the situation where the company doesn't have the cash. And if the company doesn't have the cash, it's not able to make contributions and it's not able to make loans. It's not going to be the organisation which is able to actually fund the trust. So we have to find another organisation to fund the trust. And that organisation is an external financial institution, typically a bank. So this is where company is cash poor, but asset rich. And because of its asset wealth, it's able to provide appropriate guarantees through collaterals to the bank in order to establish the basis for the funding. That might be, of course, that funding doesn't go directly from bank to trust. It could actually go from bank to company, in which case company in receipt of the money is then enabled to actually make contributions to the trust. So that's where bank funding actually funds the trust in the absence of company funding. Moving on then to the next diagram, fine. Company has facilitated the advance of loan from bank to trust. That loan needs to be repaid like any other commercial loan. How does it do this? So, in those circumstances, typically we will not introduce a dividend waiver into the trust deed. This enables the trust to actually receive dividends. It's therefore empowered to pay interest, if indeed it is the recipient of the loan. Any additional monies which are required to pay the loan repayments or the interest charges are funded by contribution from the company. Moving on to this next diagram, diagram 4. This is where the employees become shareholders through the transfer of trust shares. So illustrating that the company has an arrangement with the trust, which we call an operating agreement, which is a separate agreement, a separate document to the trust deed, which is effectively the constitution of the trust in inverted commas. And so the shares move from trust to employees, yes, effectively, to all intents and purposes, the trust assisting the company for the company to actually fulfill its obligations to the employees. I always establish the share arrangement, the share contract, if you like, directly between company and employees rather than between trust and employees. So, for example, in an option arrangement, the grant of the option, I always arrange by the company to the trust. The exercise of the option goes the other way, from employee to the company. But through the operating agreement, the trust has this arrangement with the company, provided that it is in a position to do so through ownership of the shares, to transfer shares to the employees and ensure that those obligations are met. And so what we see here is the start of the process whereby shares are recycled from generation to generation. Yes? At some point, the employees will move from bottom right-hand corner to bottom left-hand corner and actually sell their shares to the trust. Yes? Typically, as in the Peninsula Newspapers case, it's on retirement. So that was the principle which established a connection in US legislation and in US employee share scheme practice between succession planning and retirement planning. So once the shares are then sold back to the trust, they can be recycled back to the new generation of employees, and so the generational transfer of shares goes on. Okay, I've identified in this next diagram the identity of interest principle. This is not a legal term of art, but it's a recognised and well-established term in employee share scheme parlance. It was a term which was used by Louis Kelso and which has been transferred down through the generations of share scheme practitioners. It was, by the way, Malcolm who went over to California in 1985, I think it was, Malcolm, wasn't it, on behalf of Unity Bank, met with Kelso along with David Reed, and brought the principle back into the UK, and hence the proliferation of activity which we represent today at our Guernsey annual Employee Share Scheme conference. Okay. Yes, I often use an anecdote to actually illustrate this principle of identity of interest, and it usually works very well, so I'll share it again with you this morning. Many years back, I was presenting at an extraordinary general meeting on behalf of a quoted company that was quoted on both the UK Stock Exchange and the Irish Stock Exchange, and indeed also, in fact, the New York Stock Exchange. And we met in the Shelbourne Hotel in Dublin with the shareholders, and one of the shareholders stood up and told us that he was a long-suffering shareholder. So I respected that. He was a shareholder, of course. You respect the shareholders of the company. And I listened very carefully to his question. And he said, Mr. Craddock, it's all very well talking about share schemes for the employees, but what about a share scheme for the long-suffering shareholders? Well, I very courteously answered, the shareholders have their share scheme in the ownership of the shares. Yes, the shareholders' share scheme is the share ownership. What we're trying to do is establish that identity of interest between employees and shareholders through the introduction of employee share schemes for the employees, so that all are united, shareholders, management, employees, everybody involved in the company's development around the totem, yes, the totem of the developing share value. And he recognised the principle, and we had a very interesting and respectful discussion at lunch. The key principle, of course, is this, and this is the principle which I highlight here in the second bullet on this slide, which is that the employees are going to be much more inclined to develop capital value for the shareholders if they themselves have an interest in the capital value that's being developed. Absolutely key and fulcrum to our understanding of employee share schemes. This next slide illustrates the operating agreement arrangement. Remember, as I'm sure all you trustees are well aware, certainly all the trustees that I work with in these islands are aware, so I'm sure you are, the company cannot give instructions to the trustees. The company gives recommendations to the trustees. For the company, they might see it as substance over legal form. We can tell the trustees what to do. I courteously encourage them not to think like that, and most of the directors within the companies that I represent do respect that advice. For the trustees, of course, it's always legal form over substance, the legal status of the trust, the independence of the trust. And that's what I seek to actually illustrate in this next slide, the all-importance of the independence of the trust, the independence of the trustees, which is often just one trustee in the form of a trustee company. This independence is so important, and it was reinforced in the very important case of Dexter v. MacDonald in 2002, where its special commissioners, as it was then called, it was established that the independence of the trust is the principle which prevents any charge, any tax charge arising through a challenge from HMRC that there might be a preordained series of transactions. Yes? This is the body of case law which emerged in the early 1980s, known as the Ramsey Doctrine. The key case then was, that followed from Ramsey, was Furness v. Dawson, a whole range of other cases, White v. Craven, I seem to recall, many others, which debated this issue. But the fact that the trustees can effectively do a de Gaulle, and say, no, yes, that they can actually assert their independence, is the principle that I'm sharing with you, means that this cannot be construed as a preordained series of transactions. If it were a preordained series of transactions, then the tax authorities could look through the preordained series of transactions as though they had not existed and establish a tax charge. So the all-important independence of the trust. So very, very important indeed. Let's go on to this next slide. What is the tax position for each party arising from this employee share trust structure? Well, what about the company? Okay, well, there is not a corporation tax deduction on the transfer of cash from company to trust. There is, though, an alternative opportunity for the corporation tax deduction, which in the updated legislation is in chapters 2 and 3 of Part 12 of the Corporation Tax Act 2009. So when an individual employee participant realises an income gain, yes, so typically through the acquisition of shares or through the exercise of options leading to the acquisition of shares, that income gain, we're not talking about capital gain here, we're talking about income gain, the level of that income gain, the quantum of that income gain establishes the basis for a corporation tax deduction. Potentially, at least, that could be higher than if a deduction had been given early on the contribution to the trust, for the simple reason that the gain represents a market-generated gain. So the extent of the corporation tax deduction depends upon what gain is generated through the market at the date the individual takes acquisition of the shares. And that deduction is available whether or not the shares are acquired through a tax advantage scheme or a non-tax advantage scheme. What about for the employee share trust? One of the reasons, indeed, why we work with the offshore jurisdictions, most fundamentally, of course, because the body of administrative expertise lies here, but there's also a key tax advantage that the employee share trust is not resident in the UK. So any sales, gifts, transfers of shares from the trust to any party are not subject to UK capital gains tax, and within these islands there's not a capital gains tax regime within the indigenous legislation either. Okay? If that capital gains tax advantage didn't arise, was not available, then company would have to put more money into the trust in order to fund capital gains tax liabilities arising on sales, gifts, or indeed any form of transfer of shares from the trust. What about employees? I mean, this really is win-win-win all the way around, isn't it? It's tax reliefs for the company, tax-free reliefs for the employee share trust, and for the employees, of course, we use the employee share trust to lubricate, to facilitate the operation of the employee share schemes. So working with bona fide employee share schemes, often they will be tax advantage schemes, and any benefits which accrue to the employees arise from the tax reliefs and exemptions which are enshrined within the tax relieving legislation for the tax advantage schemes, or indeed if they're non-tax advantage schemes, then it is possible to construct schemes which are built upon and use reliefs from the general legislation. There's this issue, of course, about accountability for tax for the employees, and here we need to understand the implications of Section 702 within the Income and Corporation Taxes Act 2003. If the shares are readily convertible assets, by which we mean that there are trading arrangements in the shares, then we're in a situation where there will be income tax accountable through the payroll system, through the PAYE system, and also national insurance contributions will arise. If the shares are not readily convertible assets and there are not any trading arrangements in existence in the shares, then the accountability is for income tax only through self-assessment, and there is no charge arising to NICs. The reason I share this principle within the confines of this conference is simply because the trust represents a market. Yes? Even if there's no trading in the shares, the very existence of an employee share trust, HMRC recognise as the existence of a prevalent market. And so it follows that even the existence of a trust, even where it's not even traded in shares, actually establishes trading arrangements for the shares, and the shares become readily convertible assets with the principles applied as I've explained.
5 minutes.
We've got 5 minutes. We started at 20 past. 15? Yeah. Okay. I'm trying to keep it interesting, you know. Right. So we go on to the next slide. So far I've talked about the classic employee share trust, which is familiar with you got people here on the island of Guernsey and indeed on the other island of Jersey, the classic employee share trust. This is working with general principles for the operation of the employee share trust in terms of Jersey trust law, working alongside employee share schemes which facilitate UK share scheme law. We now move into a different world here. In 2014, enter the Employee Ownership Trust. So this does have bespoke legislation, but it operates in a very different way from the classic Employee Share Scheme Trust, which I've explained previously in my presentation, which emanates from the work of Louis Kelso back in Palo Alto in 1956. The inspiration for the Employee Ownership Trust comes from John Lewis. Graham Nuttall, who devised the scheme, is very open that his inspiration was the John Lewis model. The John Lewis model has never appealed to the operation of the tax-advantaged employee share schemes for its operation. Instead, it operates as a self-contained mechanism operating in a way which essentially takes control of the shareholding. Okay? So the employees, as I understand it from the John Lewis model and from what has been revealed to us through the Nuttall research, never actually transfers shares out to the employees, unlike the operation of the tax advantage schemes or even the bona fide non-tax advantage schemes. But the way in which the Employee Ownership Trust actually builds upon this model is to actually build in certain tax reliefs. And the tax reliefs are essentially twofold. Okay? Essentially twofold. The first is a capital gains tax exemption for a qualifying disposal of shares, okay, provided the trust actually takes control of at least 51% of the share capital of the company. So it effectively takes control of the company, okay? And the transfer must be from persons, not corporates. The vendor then makes a claim for the tax relief. The two key exemptions which I've identified on this next slide are firstly that the capital gains tax exemption is treated as a qualifying disposal of shares for tax purposes and does not ignite at all any form of tax liability, whether an income tax liability or a capital gains tax liability. There's then the income tax exemption, which is on qualifying bonus payments. Provided this trust is in place and the disposal has been made to the company in the way that I've outlined, then there is an opportunity to pay bonuses to employees of the company at the tune of £3,600 per tax year, provided that payment is made to all qualifying employees on the basis of a definition which complies with same terms. So throughout its structure and throughout the basis on which it operates, it has very serious echoes of John Lewis. Moving on to this next slide, one of the implications of the rules on loans to participators for closed companies, whether it be the Employee Share Trust or the new 2014 Finance Act Employee Ownership Trust. Well, there's no exemption at all on this for the Employee Ownership Trust, just as there isn't for the classic historical Employee Share Trust. This is the arrangement whereby a loan is made by the trust to the company. typically this will be regarded as a participator. The trust will be regarded as a participator, and so a charge can arise under Section 455 of the Corporation Tax Act 2010. So effectively, where a loan is made from company to trust, it's treated as a form of shadow advance corporation tax. Yes? If it's not paid, if it's not repaid within 9 months of the end of the financial year in which the advance was made, that charge to tax arises. It is, of course, possible to recover that tax when, in due course, the loan is repaid. So effectively, it's a hit on the cash flow. But important to recognise that this same principle, as enshrined in Section 455, applies to the employee ownership trust as much as it does to the classic employee share trust. In the event that the trust is funded not by loans but by gift contributions, then that particular aspect of the legislation, Section 455, does not apply. Okay. What about the implications of the inheritance tax rules? Well, we'll always seek to establish the employee share trust. It is a discretionary trust, of course. We'll seek to establish it as compliant with Section 86 of the Inheritance Tax Act 1884. And in those circumstances, we have an exemption from a whole range of charges, including the 10-year anniversary charge, which I've explained in detail in that slide. So given my allocation of half an hour, which is often the case, half an hour or 40 minutes, I always load up my slides with detail so that you can then go back into your offices and use this as a point of reference once you're actually working with your clients. Okay? And there I've outlined some more detail on the loans to participators, emphasising that there is no exemption at all for the employee ownership trust. Okay, so how can the funding be arranged to enable the trust, whether it be an EOT or a classic employee share trust, to pay the purchase price of the shares? Well, the trustees might actually, as we indicated earlier, approach the bank with a view to borrowing. This might not be practical, though, for a small company. Okay? And it might well be that the circumstances of the MBO mean that in itself makes it impractical to approach the bank for funding. There could be funding from the company, as we've outlined earlier, which is scenario 2 that I've set out on this slide, or scenario 3, which is that the vendor acquires a status of unsecured creditor. Okay? And in those circumstances, of course, that needs to be managed. It might well be that the vendor is prepared to remain as an unsecured creditor, but he or she must have confidence that the company's got the capacity to generate the funds in order to extinguish that debt and actually pay him out in due course. Okay? This particular slide identifies the contrast between using the historical employee share trust under the potential newspaper cases scenario and the employee ownership trust. Okay, so where we've got bank loaning and there's an immediate sales proceeds to the vendor, as there was in Peninsula newspapers, then company contributions are used to pay off the bank. Yeah? And that was the projection within Peninsula newspapers, and that's the projection in the companies that we use these principles for purposes of MBOs, that the company will in due course generate enough wealth in order to pay off those loans. In the employee ownership trust scenario, if there's no bank funding and there's a deferred sale proceeds to the vendor, then the company contributions are not used to pay off the bank, they're used to pay off the vendor. And if you like, we could put it like this: the vendor is funding the arrangement through the unsecured creditor status. Okay. Slide there which highlights this particular point. Let me just emphasise this point, that although on the loans to participator rules there is no exemption for employee ownership trust, it's the same status as it would be for the classic employee share trust, on the inheritance tax rules there are certain exemptions for the employee ownership trust, and I'll highlight those on that slide. A couple of further points, just drawing to conclusion. On this next slide, the point about distribution. So the question can often arise, is any contribution to the trust, given that it's a participator, given that it's a shareholder, is there any risk that it actually could be classified as a distribution? My understanding, which I discussed with one of your colleagues at the ESOP Centre sometime earlier this summer, Malcolm, is that the ESOP Centre has actually received an indication from HMRC that it will not treat a distribution to an EOT as a distribution, and that we can actually extend that principle by inference, it's not unreasonable to extend that principle by inference to the classic employee share ownership trust. Okay, so just drawing things to a final conclusion here. What do we do with the EOT? Is it useful? We're currently in discussion with two potential clients for the EOT. The gestation period to move to a point where we can implement and start the work in earnest is proving to be long. It's proving to be long. The classic employee share trust, of course, is a tried and tested mechanism. We can often work that alongside capital gains tax liabilities of no more than 10%, working with mainline entrepreneurial relief and indeed also the special entrepreneurial relief for EMI, both of which produce no more than 10% capital gains tax liability. The EOT technically could be established offshore. If it is, then it does actually put the trustees in a different scenario altogether. If they're going to own 51% of the company, they're going to want an enhanced position on information. They're going to want significantly more information in order to take on that role. It does actually change the status, in my perception at least anyway. I'm interested to know what your views as trustees are of the employee ownership trustees. One of the clients we're working with, we are in discussion with them about having some form of hybrid arrangement whereby employee ownership trust owns 51%, and we establish alongside that a classic employee share trust on the Peninsula Newspapers model that I've gone into detail in this presentation. And through that classic employee share trust, we operate the bona fide employee share schemes, including the tax advantage share schemes. Important to note also a couple of final points. The EOT does not preclude the operation of a SIP, although the EOT itself cannot be a SIP. And the SIP, of course, has to be offshore. The EOT could be either onshore or offshore. And another very important point that even though the EOT would take control of 51% of the share capital in order to facilitate the tax reliefs, and therefore the company would technically not be independent, there is a provision in Finance Act 2016 that says that this does not preclude the operation of EMI. Normally, of course, if a company loses its independence, that would be a failure of the independence test for purposes of EMI. That will not be the case in the context of an EOT. So I offer a whole range of principles there in this presentation on the classic employee share trust, all based on that Peninsula Newspapers model from 1956 in Palo Alto, but also from this new model that is there for our consideration, the EOT. How can we constructively use that within the metrics of our thinking with clients? And I've offered you a number of thoughts for you to consider on that also this morning. Thank you very much, and I wish you all the best for the rest of this conference. Thank you.